It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader in less than 5 minutes per week. The video newsletter is brought to you by TradingTips.com.
Welcome to this video newsletter on Bollinger Bands, a technical indicator for determining support and resistance, as well as if a stock is overbought or oversold. Let's begin. What are Bollinger Bands? Well, they are a statistical overlay invented by John Bollinger in the 1980s. Typically, they rely on a stock's simple moving average, although some traders prefer using exponential moving average. Your charting software should give you the option. Anyway, once the stock's moving average of choice is determined, usually based on the prior 20 days worth of trading, upper and lower bands are added to the stock chart, with the upper band usually representing the moving average plus 2 standard deviation points, and the lower band typically representing the moving average minus 2 standard deviation points. You may remember from math class that 2 standard deviations encompass 95% of normal distributions. The idea here is to set a normal range, with anything outside of the range looking abnormal and thus being a trading signal. Stocks that are near their Bollinger Bands may face support or resistance, and stocks that are outside of their Bollinger Bands may be overbought or oversold. Let's continue. First, let's look at support and resistance. Bollinger Bands don't technically offer support or resistance like trend lines on charts, but they often behave like support or resistance. For instance, a stock will often rebound off its bottom Bollinger Band and go higher, or repel off its upper Bollinger Band and go lower. And, just like support and resistance, when a stock pierces through one of its Bollinger Bands, this often signals a new trend. When a stock is near its top Bollinger Band, it can be considered overbought, and when it's near its lower Bollinger Band, it can be considered oversold. However, it's important to consider the slope of the Bollinger line. Stocks often ride the band, i.e. they'll ride an ascending Bollinger Band higher or a descending one lower. Thus, for a stock to be overbought, it needs to be near an upper band that's descending, or for a stock to be oversold, it needs to be near a lower band that's ascending, or at least flat. Here's an example. You'll notice that the trading activity near the beginning of this chart is rather volatile. This is right when the financial crisis was really beginning to unfold. In January, the stock hit its upper Bollinger Band and then repelled to its lower band. Here you'll notice that it rode the band, the descending lower band, lower, until it again repelled off its bottom band. Take a good look at this chart and notice what a reliable indicator Bollinger Bands really are. It's very rare that a stock consistently trades outside of its bands. In this second example, you'll notice much of the same thing. Notice the anomalous day of trading in early May, when the stock pierced its upper Bollinger. This was an overbought signal, as the stock quickly retreated. Most notably, of course, are the prices in mid to late July. There's nothing in the Bollinger Bands that could have predicted this sharp move upward in mid-July. It was based on an earnings report. But you can see that the stock rode the band, on top of the band actually, higher. Once the stock confirmed this trend, not once, but 2 days in a row, it was a clear Bollinger breakout. Some final thoughts. Bollinger Bands are a non-proprietary indicator, which means they're available for free on most statistical packages, even at Yahoo Finance, for example. Like most other indicators, Bollingers shouldn't be used in isolation. If you get an overbought signal, for example, take a look at what the RSI, MFI, stochastics, and parabolic SAR have to say, too. If you get conflicting data, then the signal may not be as strong. Another thing to consider is the width between the bands. Narrow bands represent a period of low volatility, when the difference between highs and lows has been small. Many traders perceive this as a sign volatility is about to pick up, as they feel it must even out in the long run and return to the mean. The reverse would be true of very wide Bollinger Bands. And finally, it should be noted that Bollinger Bands can apply not only to stocks, but also to Forex, precious metals, and other financial instruments. Options traders often use Bollingers to go long on puts and calls when the bands narrow, and short when they widen. We hope you've enjoyed this TradingTips.com video newsletter. Thank you, and good trading.
This Trading Tips video newsletter has been brought to you by Manny Backus's First Hour Trading System. Every day there's money to be made in the first hour of stock trading. This is the world of day trading, not for novices, unless you have a system. The First Hour Trading System. Visit firsthourtrading.com now and sign up for a free 30-day trial. You could make enough in the first hour of your day to take the rest of the day off. Do you want to view more Trading Tips videos? Visit tradingtips.com. Sign up for our free video newsletters. Become a successful trader by visiting tradingtips.com.